expressed by the program participants are their own and do not reflect those of Blue Line Futures, LLC, or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures and options trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition. As a CTA, Blue Creek Capital may or may not hold positions in the assets discussed.
Hi, I'm Bill Baruch, and I'm here with my partner, Oliver Slope, and we're the founders of Blue Line Futures, an independent introducing broker, and Blue Creek Capital Management, a commodity trading advisor. And this is Trade It or Fade It. Well, before I jump into the gold trade I've been kind of leading into the last couple of episodes, what do you see in the grain market?
Grain markets, as mentioned last week, this is like the never-ending Super Bowl for grain traders. You get a lot of volatility. You see that seasonal rise in the CVOL index for corn and soybeans specifically, and we're at that time of year where it's just very weather dependent. I think this afternoon's crop progress report showed, I think 92% of the corn crop is planted, and so that means the shift focuses not to planting but to crop progress. Currently, I think this afternoon's good to excellent rating, 69%, good to excellent, just a couple points below the average analyst estimate. But what's going to be important is weather. The I-states, Iowa, Illinois, Indiana, have been extremely dry over the last couple weeks and don't really have a shot of rain in the forecast, or a meaningful shot of rain in the forecast for another couple weeks. And if that gets moved up, potentially we see a little bit more risk-off trade.
Okay. Yeah, that's it's been an interesting trade. It's been a tough trade. I mean, unless you've just been short and kind of weathering through some of the big rips that then fade out pretty quickly.
Well, it's a market environment where there's opportunity for traders on both sides of the market, right? We saw a huge rally last week, 5-day rally in the corn market. I think we tacked on like 49 cents in that July contract. Sold off 10 cents today. Beans were down about 40 cents today. But I think you're going to continue to get that ping pong back and forth until we get a better idea of weather and the impacts of that on this year's crop, and that might not come for another couple weeks. So expect the volatility to continue here on out.
And did I see that right today? I think the price of corn is higher than the price of wheat for the first time since
2013, which I could have swore that happened earlier in the year. So I'm going to have to double check that one. But I did see that headline.
Yeah, I'm just observing. You know it. So I'll see. I think that's an interesting fact.
We'll keep you posted on that one.
Keep you posted on that. Well, the metals market has been bludgeoned as well recently, and so if you look at the month of May, silver's down more than 7%. Copper's down about almost 6%, 5 to 6%. Gold, though, has hung in. And today was an interesting day with gold. You had the holiday session, and last night around the European hours, we went down. Gold stuck its nose below a new low on the August contract, traded just below 1950. And it finished the session up by 1977, 78. So really nice reversal. And this is kind of what we've been waiting for. We get the pessimism and some of the more volatile metals has definitely taken place. And then you get a nice reversal here in gold. A big week ahead. Before I jump into some of the facts I'm thinking about here, what are you seeing on this metals trade?
Well, you know that I am a permeable, so disclosure there, full disclosure, been stacking physical, but the 100-day and the trendline support from those November lows is something I've talked about here in the last couple episodes, and that was tested almost to a T and held pretty darn well so far, knock on wood.
Let's see. Yeah, I like that. Let's not come one more time. Well, you're stacking physical. I'm thinking about stacking some option trades here, and so I'm seeing some value. Before I jump into the structure, I like the fact that we're now seeing today's finish, and there's definitely some distortions in the Treasury market right now, which creates distortions in the Fed funds futures, and so it may extrapolate into how we're seeing the odds of a Fed hike. So according to the CME Group's Fed Watch tool, we're better than a 60% probability the Fed hikes 25 basis points at their June 14th meeting. And that's as of today's close. I feel that's fairly accurate. I mean, so give or take 10% or so, but you're talking about a better than a coin flip. The Fed is now going to hike 25 basis points. So we've been waiting for those odds. If you've been following the last few episodes, I've been talking about those odds needing to pick back up, and gold has held really, really well. The other factor is we've seen CVOL in gold come down significantly. So in the banking crisis, in the thick of that banking crisis in March, CVOL, which can be found on the CME's website, it measures, it's an index measuring implied volatility, which really is, are options expensive or are they cheap? And if you need to find it, Google search CVOL CME, and it will pop up, and you can search and click on that and take you in there. It was as high as 22.5 in March. It's down to 16.5 as of today. That's what we're looking for. It's going below that 18 area where it's consolidating. Options are cheaper now, and I can see that in the payout structures. So what I'm looking at, August gold is now front month, and I want to give it a little bit of time to get through this summer. So August gold expires towards the end of July, and you basically get almost 2 months, a 2,000 to 2050 call spread, $12 to $12.50. And I've talked about that before. How many times can that cost go in the width of the spread? And that's 4 times there that can happen. So I like this structure. Again, it's August 2000, 2050 call spread. That's where I see value. I'm starting to get into those in some of the funds that we're trading, or the commodity trading advisor programs that we're trading. So that's how I see it. What are your thoughts on something like that?
Well, I love it, and I like the fact that you give yourself a little bit of time frame there. As you mentioned the banking crisis as if that was something that happened, a year ago and was prolonged for multiple months on end. But this day and age, it's just a revolving door of news headlines, and giving yourself that time, potentially something else kicks up and really gets gold and silver going again.
Yeah, and you got a lot this week that can play into it. So I see value given the way the structure is now playing, where some of those odds, the CME odds, the CVOL indicator, where all this is, I think it's finally time for me to be stepping into that. I've obviously been a little more aggressive, towards the end of last week and heading into the long weekend to see how things played out with the debt ceiling. Because I look back at that debt ceiling in October of 2013, and gold and bonds rallied out of a deal there. And I was sort of comparing this situation more to that than 2011. I'll leave you with this big week of data. China tonight, Tuesday, 8:30 p.m. Central Time, has PMI data, and the yuan with the CNH, which is a futures contract on the CME. It measures the USD CNH. So the higher it goes, it's the dollar strengthening. The lower it goes, it's the yuan strengthening. It's tradable futures contract. Keeping an eye on that tonight. You got manufacturing PMI data out of China at 8:30 p.m. If that comes in stronger, I would imagine the Chinese yuan strengthens. Could be a tailwind to the metals. And then that takes us into some of the data this week. We got JOLTS tomorrow. We got ISM manufacturing on Thursday and non-farm payroll on Fridays, with a bunch of other things scattered between. So a big week ahead. That's how I'm seeing gold. You could trade it or fade it.